Hi, and welcome to Random Rogers Big Picture for the week of April 27th, 2008. It's rolling right along. I stumbled across something that made a reference to the David Swensen portfolio. It might have been on, what's that site called? Abby something. Abby Normal. Yeah, Abnormal Returns, a little Young Frankenstein joke. Anywho, but it occurred to me that it's becoming more and more possible for do-it-yourselfers to recreate the Swensen portfolio. We'll get into whether that's a good idea or not in a second, but bear with me here. The Bespoke, Paul and Justin over at Bespoke posted a while ago, I was able to find this, what the 2007, as of their report, what their allocation was. It was, I'm just going to round off, 23% absolute return, 11% domestic equity, 4%, only 4% fixed income, foreign equity, 14%. So they're foreign equity 14, domestic 11, private equity 18, real assets 27, and cash just a hair under 2%. So, as I say, we're moving to a point where this can be recreated with easily accessed products, exchange traded products. Absolute return. I've mentioned a few times owning that RIDEX at RY, the name is too long, but RYMFX in my HSA account. That's a long-short type of thing. There are plenty of long-short funds. Some of them do better than others, and you really need to look under the hood and really understand what they're doing. But for purposes of the video, there are plenty of choices. The merger fund might be another example, kind of an absolute strategy. One of the Hussman funds, depending, maybe one of the buy right products, but probably not. But the point is that there is plenty to choose from, and I have faith in this one RIDEX product. There must be others that are doing relatively well, and if these things become popular, what that really means is that you're going to see more of them come out. I'll touch on that in just a second. Domestic equity, that obviously is very easy to access, where they only go 11% into domestic equity, then really what all they're trying to capture is beta, as they like to talk about at these indexing conferences, as opposed to alpha. So with beta, anytime you read someone's trying to capture beta, they're just trying to essentially go along with the market for the most part. It can get a little more nuanced than that, but really at only 11% domestic equity, it doesn't really, even in $1 million portfolio, it doesn't really leave too much room to get too fancy. Fixed income, that's easy as far as domestic, getting easier with regard to foreign. I'll disclose I bought that WIP product for most clients above a certain size earlier this week. To me, that seems like a good total return vehicle. It's not a good yield vehicle, not at all really. But I do believe that foreign fixed income is going to get easier to access. The BWX product, I own a little bit of it, but it's not ideal in that it's so heavy in Japan. The yield is fine, but it's not that good. What else do we have? Foreign equity at 14%, similar to the domestic equity. You may not cut it too fine-tuned. It may there just be more about capturing beta, capturing the effect. I don't want to say EFA. I think, regardless of your portfolio size, you can probably go a little narrower than EFA in assembling a couple of things in the foreign equity thing. I've got dogs all around me here. Anywho, next up, I'm going to skip over the next one. Let me jump to real assets at 27%. That's a big number, but it takes in a lot of different types of things. I think they're assuming real estate. It may take in timber, also, all sorts of commodities. There are plenty of commodities, and you could even stretch to include some stocks are, something like potash. Could you lump that in as commodities, kind of, to the extent commodities even counts as real assets. That's in the eye of the beholder. But 27% for me personally is an awful lot, and not something that I would be terribly interested in having, that much weight. I've talked about that over, ad nauseum. Circling back now to private equity at 18%. I'm not a huge fan necessarily of too many of the private equity products that are out there. The two PowerShares ETFs, it's PSP, and I believe the foreign kind is PFP. Those own a lot of companies or a lot of the holdings, it's not the pools of capital that you're buying, but you're buying shares in the company that manages the pools of capital. In the PSP kind, for example, you've got Fortress, which I think is FIG, and you've got that Blackstone, which I think is BX. With those two, and there are others like it, you're not buying a pool of capital and going along for the ride. You're buying the management company. When times are good for private equity, then I would think the stock would go up. And when they're not good, like it's been, I would think the stock would go down. Don't take that as a prediction of any kind. I don't follow that. I don't really know how to evaluate those companies. But there are some exchange-traded vehicles that do tap into pools of capital. I own one for a few clients, the MVC. It's down a little since I bought it. It's come back from where it was. I'll say my timing on it was poor, but my long-term faith in what they're doing, for now, I have it. If you look at how it's done over time relative to some of the other ones in the group, it's done pretty well, relatively, which leads me to think that they're doing something right. I found a few others that I don't think are listed. I'm going to read you the ticker symbols. I've not researched them a lick. I'm just telling you that they're there. PCAP, TICC, HTGC, GLAD, MCGC. All of these things are way down from their high, 50-60% off of their high. To the extent they need to access any sort of capital market to fund what they're doing, maybe that's the problem. Not sure. To the extent you care, you can figure that out. And it doesn't really matter that these are down a lot. The point, or that they were up, if that were the case, the point is that there's a lot of these out there, and there probably will be more. And even if all of these suck, there will be ones that, in fact, turn out to be pretty good. So, and the other thing I wanted to throw in there is a lot of these products that I'm written about a little bit in Canada that I'm finding, these hydro funds. There's some interesting stuff I found in Australia. There's one, if you look, Duet. It's like a closed-end fund, sort of, from Macquarie that owns a bunch of Australian, not a bunch, it only owns 4 or 5, but it owns Australian and New Zealand utilities. Interesting concept. The point is not that you should own these particular things, but that these products are out there, there will be more of them, and it will allow you to, if someone wants to assemble something like this, do it and feel good about doing it. I'm kind of running out of time here, so I will close by saying, should you even do this? If you were to read a Morningstar article, it would tell you, no, don't even think of it. At least I think it would. Maybe I'm being too critical. The point is not so much should you do this, because the answer probably is no. You shouldn't look at this chart I'm going to post below the video and duplicate it, because you're not going to have access to when they make changes. So to me, I think that's a piss poor idea. Where I do think there's value is doing your own legwork, not following someone. You can assemble something like this. It would be different. You would not be copying them, but taking similar asset classes, putting together percentages that make sense to you. 27% real assets is not where I want to be. I might do it differently if I were to do this. I even found, I'll close one last thing, I found a timber name. I will go ahead and, that's new to me. I think I'm going to write about this for TheStreet.com in a little more detail, and I'll include it there. Have a good weekend.